Okay, that's what Novo's looks like. Bit worrying, so be careful because it had this massive drop. Now imagine you get in when, as I say, things are overbought, and I say to you, there's a small probability it might continue, but most times when it's like that, it's going to fall. You might say, no, bullshit, I'm getting it 124. Well, you might end up with that. The idea with a quality 5 plus company, of which this is one, is either to buy more or to wait it out and hold it for a longer period as part of a portfolio, not as a single stock where all your money's in that and nothing else. And don't look at it as just one thing and nothing else. Okay, otherwise you would panic. Okay, why do I look not just at UK stocks but also at US stocks? For this reason, because that's the poverty gap. Your IFA is going to match at best, and they're not even going to match this. They're not going to match the index tracker of the UK. Over the last 10 years, the UK index tracker is up 50%, right? So your pension might be up 40% after fees and after crap underperformance, right? Go find out over the last 10 years. Ask your IFA, what's your typical fund client return over 10 years? And they'll go, yeah, 50%. All right. In the US, the typical index tracking fund, if it's tracking the NASDAQ, is up. Well, they also underperform the index, so under 370%, but maybe 300%. Okay, and the Americans are pissed. They only, got 300%. So they quadrupled their money, and they're really pissed that they only quadrupled their money by getting a 371% return. They're really angry about that. They're like, what the frick? We only got quadrupled our money. Index tracker would have done better. Anyway, thanks to people like him. So I like to follow people like him. Former hedge fund manager at DE Shaw, would you believe? People don't realize that. It comes from the same industry as me. That's the Brits. The Brits are getting poorer and blaming it on government, blaming it on, I don't know, illegal immigrants, asylum seekers. God knows what they're blaming it on. Whatever they're blaming it on, they're not blaming it on fund managers. Perversely. You know who I'd blame shitty pensions on? I wouldn't blame it on the chancellors. I wouldn't blame it on the tax rates. I wouldn't blame it on any of that. First people I'd do is not even the lawyers. Unlike Shakespeare, first thing I better not say it actually, because this goes on social media. I'd go after the fund managers. I think you all know the quote from William Shakespeare about lawyers. Right. Model portfolios. Now, my team of rocket scientists, they're not really rocket scientists. I like to think of myself as Elon Musk and a team of rocket scientists, but we're not. We want to create those kind of 21 rockets, okay? Well, 20 rockets. That's my dream rocket. That's mission to Mars. 30% annualized return, 10% volatility. I've not managed to create that yet, okay? I've had a student who's got very close to that. The past is not a guarantee of the future. Sadly, I wish it was. The first person to wish it was is me, my friends. No webinar whatsoever. That too from one of the largest pension providers. Well, there you go, Jubin. I know. Can you believe it? I do one a week, free, because I love it, on an evening. You know what they're doing on an evening? Watching Netflix, because they give a damn, don't they? Okay, so that's what I want to know. There is no guarantee of that. There is no implication in anything I'm saying of that. If I get that, I'm happy. Okay, so that's the rocket I want to create. Some of these rockets are crap and I don't want them. Okay, I'm just giving you the statistical options. So that's what we're going for. By the way, if you want to look at their portfolios, here they are. If you want to know what wife and son own, well, those by implication as well, because it's in there. Okay, I wouldn't buy that at the moment. That we're keeping a close eye on, as I said. This we're not really looking at. They're happy to, but not looking at it. Anything on here that catches my eye? We will one day look at that again. Okay. Now, why do we try and avoid daddy bears or years like 2022? Because that's what we're after. That's what we're after. Okay. Now, the easiest way to get rich is by, I'm going to tell you in a second what this instrument is. I think I'm going to tell you. That's it. Imagine your portfolio looked like that. Could you handle it? And if you could avoid the daddy bear, which I've explained, I'll explain again, the falling short medium-term prices, then you'd have even avoided most of that. Even if you avoided half of that, you're still making a lot. Would you be happy with that? I didn't do that. I didn't create that. I didn't invent that. I didn't invent that. I can't take credit for it. I didn't invent the company or the portfolio that made that. That's a simple index tracker. That's actually an exchange traded fund. Okay. What I want to do, and I can't guarantee it, is I want to start off with, okay, at the end of 3 years or at the end of 5 years, how much is a million? Oh, sorry, at the end of 3 years, how much is a million likely to be, and what are the probabilities? Now, it might only go up to 1.5. It might go up to 2 to 2.5. Might happen sooner if there's tailwinds, and it might happen might go more if there's tailwinds, and I might get less if there's headwinds and take longer. Those bits are out of my hands. I want to know my drawdowns just so I know how bumpy the road's going to be. And the maximum drawdown in the pension might be 15%, but if I'm expecting it and know it could happen, I'm less likely to panic. Well, I'm not going to panic anyway, and I also know there is a slim possibility it could be deeper, but I know if I've got quality companies, it should be fine. I also know if I run the numbers on the portfolio, then I want to know what's the probability that 50% of the time I'm going to get more than double the money and below. So this kind of data, this is just for illustrative purposes, okay? And I want to break it down year by year. For each stock, I want to know, okay, what are the returns? Now, I don't know in a given year whether one stock's going to do that, isn't that bloody amazing, or the same bloody company 2 years earlier did that, okay? I wish every year, every stock went up. Doesn't happen. Some of them go down month after month after month. I want to talk broader problems. This is how most people pick stocks, as you know if you watch me. The reason I say you want 20 to 40 is because after 40 you've got too many. And the problem is your IFA will send you funds, and those funds will have about 100 stocks in them, which is a complete waste of time other than for the fund manager and the broker that he uses to buy those funds through. Buy those stocks through. Utterly useless. Statistically, mathematically, academically, all proven, utterly useless for fund managers to have more than 40 stocks, okay? Which is why Warren Buffett has so few. Most of his money is in his top 5 holdings. 50% of his capital is in the first 5 holdings, okay? So, and less than 20, you've got a bit too much risk. And you can't remove market risk unless you're out of the market, i.e. 2022, right?